Hello, I'm Mercedes Stephenson for the West Block Politics, Perspectives and Players. Well, the Bank of Canada is holding steady with a 1.75% interest rate. Growth in the first half of this year is expected to be much slower than expected, with the hope that that will change later on in the year. But one area the bank is monitoring is global trade. And with the China-U.S. trade showdown easing, that may boost those expectations. But what are the other domestic and global factors that should be considered? Thank you so much for joining us here on the show.
It's a pleasure.
You released another update last week, and you talked about Canada's economic outlook. There were things like slowed growth, lower investment, things that people might look at and wonder, is this a negative outlook? How would you describe Canada's current financial outlook?
Well, the economy is going through a bit of a soft patch. It started in the last few months of 2018 and has extended into early 2019. And it's a result of those low oil prices that we had back last fall and the transportation constraints, and then we had some very nasty weather, which I'm sure we're just barely forgetting now. And just in general, there's trade angst around the world, including here in Canada. There's concern about the future of trade agreements and what rules we'll trade under. So any trade-dependent economy, such as Canada, is seeing a slowdown. There are 47 economies globally that are seeing this slowdown all at the same time. And so that, we think, is a fairly temporary phenomenon that by the time we get into the middle of the year, we'll see much more signs of growth. So a temporary detour is how we described it.
If a lot of this is related to trade, how much of that is related to trade with the United States and the spat between the U.S. and China?
So, well, all of the angst is around that. It's around the trade conflict that has been basically initiated by the U.S. administration. And it's not just with China, but that is, of course, the scene right now where there's intense negotiations going on. But last year, the U.S. put tariffs on steel and aluminum against many of their trading partners, including ourselves. And each of those countries brought retaliatory measures into play against U.S. exports in the same dollar magnitude. And so that constitutes a trade conflict, if not even a trade war. And so what it means is that people are uncertain about what the future will look like if your business depends on a trade agreement or depends on trade with the United States, which many of ours do. Then you hesitate to invest in order to expand your business or update your business or buy new technology. And that's where it's perfectly correlated across the world. Investment has slowed right down in wide swaths of the manufacturing sector around the world as a result of that. So the good news is it's about sentiment, business sentiment, so it can turn around. If there's a resolution of the trade conflict between the U.S. and China, we could get a positive upturn in all that.
Could get worse too.
Exactly. So we treat it as a two-sided risk, but we're somewhere in the middle right now. It could get much worse, of course, if it's escalated, but also it could very easily get quite a bit better if the whole purpose of this is to resolve the issues with China. Then many of these issues of uncertainty could go away.
The bank had investigated before and done research on how NAFTA, or USMCA as it is now, is affecting the economy and sort of investor reluctance. How much of your planning when you're putting together an economic outlook depends on assuming that USMCA is actually going to be ratified?
Well, as it stands, what we have is, just as I described at the global level, investment in Canada has been slower than normal relative to our models for actually more than 2 years, okay, since the Trump administration came to power. And so we are watching for signs that people would react positively to the signing of CUSMA, or USMCA. Here we prefer CUSMA.
That's right, renamed it.
The signing would give people a lot of relief and confidence that we were progressing. That seems to have fallen off a little bit lately because the issue of ratification has come much more to a fine point. So right now, of course, if it's not ratified, we still have NAFTA in the background. But of course, that just leaves all those negotiations kind of in limbo. So right now, companies, as they report to us, are again, hesitating to invest until they know more. We're hoping that the government's new measures to accelerate depreciation for investments will work in the opposite direction and encourage more companies to invest now. So we'll watch the data. We haven't gotten any data yet from 2019, so we have to wait and see.
Looking out west, obviously the oil and gas industry took a tremendous hit over the last year.
Yes.
What do you forecast? Do you think that there's going to be a recovery in that industry?
Well, so what we have to remember is that the price of oil, 5 years ago was, $100 or thereabouts, or 90 something. And many plans were based on the maintenance of a high oil price. And the first big wave of decline was in 2014, late 2014 or 2015. We went all the way down to $30-odd a barrel. And then we've settled more or less in that $50 to $60 barrel range. So companies are still adjusting to $50 to $60 oil. They did a lot of the adjustment. They've reduced their costs. They've reduced wage costs and other costs, and they've adjusted their long-term plans. So investment is running at about 50% of what it was back then. And now with the troubles that emerged again with weak domestic oil prices in the last fall, there's been another plan put in place to cut investment even further. So these, of course, reflected in employment and drilling activity, other upstream activities, and we have the delivery constraints acting to contain enthusiasm for longer range projects. All that to say, it's still in an adjustment phase. We think now, of course, oil prices have firmed quite a bit, so revenues are up, and you're seeing some of the corporate reporting this week. Companies showing that things have improved. The mix of cutbacks along with higher prices is turning out to be okay for the corporate sector, for many anyway. So there's reason to be optimistic that we'll settle out after the adjustment, and from then on, organic or natural growth in the sector can continue.
Recessions tend to be a bit cyclical, every 8 to 10 years if you talk to economists. And there's been a number of the big bank economists who've suggested that slowing growth and the slowing economy might suggest we're heading for a recession. Are you concerned that the Canadian economy could enter a recession in the short or midterm?
So we're not forecasting anything remotely like a recession. In fact, we expect the economy to recover to around 2% growth by the middle of this year and through this year and next year. And that the world economy in general would be growing around 3.25%, which is about its potential growth rate. So nothing negative like that on the horizon. But of course, there's always potential that there would be a shock that could cause the economy to slow enough that it would give a recession. That would almost certainly be a global phenomenon. And it would be the sort of thing of an escalation in a trade war could give you weak enough growth that it would constitute a recession. It would be a special one because it would be driven only by falling investment, and it would be rising prices because of the tariffs that people were putting on to products. So it would be a very unusual type of recession. But that's the worst case scenario as we see it today. We watch those risks as they evolve. I'm optimistic that we'll resolve those trade differences, and the global economy can continue to grow.
Do you think that threat of a trade war is the biggest threat to the Canadian economy?
Oh yes, it's the biggest threat to a number of world economies, including our own. If there were something homegrown for ourselves, our biggest risk is the overhang of debt that we carry from this past cycle, household debt. And the way we think of that is if there were a shock such as a global slowdown that was more profound or more protracted than the one we are just in the middle of now, then that shock could be magnified in Canada because of its interaction with the stock of debt. But that's how we think of it. It's not like it will do anything by itself. It's all sustainable. People are servicing their debts. Arrears rates are extremely low, so everything seems to be well in hand. But it is the kind of condition that if there is a shock that affects the economy and causes unemployment to rise, it will cause a bigger downturn in the economy because of the debt. That's what we call vulnerability as opposed to a risk.
And that's why you've stayed away from another hike.
Well, that's a bigger story, but we've suggested that interest rates are about at the right level now to let us weather this little detour that we're going through. And we would still say that if our forecast proves out, as we've laid out, that the next time interest rates move, it's more likely to be up than down, but it's sometime down the road.
Governor Poloz, thank you so much for your time.
That's a pleasure.